Matt Yerkes from Cultivate, and we're here today to talk about business banking. So I have with me here Roger from Vinton County National Bank, known locally in Grove City as the Franklin County Banking Center. So Roger, what do you do with the bank?
Well, thanks for having me. I'm a commercial lender for the bank. I've been in the business since, don't want to date myself, but probably since the late 90s.
Okay, well, thank you very much. We're going to ask you a few questions today, try and help our members and people watching this video just to better understand what to expect when they're getting a business loan.
Sure, I'm looking forward to it.
Roger, the first question that I have for you is, Vinton County National Bank is a community bank, and can you just help us understand how is the loan process different when you're working with a community-based bank versus one of the large regional banks? Or, for instance, is the process much more computerized with the really big banks versus, is it a more human process with a community bank?
Sure. Well, with a community bank, at least with our bank, the lender in a particular area lives in the area, is members of associations in the area, so they really understand the area that they're lending in. And as a lender, we have our own credit limits. So if someone comes in and says they need a loan for this purpose, I know who they are, I know where they live, I know I've probably run into them with a chamber meeting or something along those lines. So we really get to know the customers that we deal with. Versus a bigger bank, you may be dealing with somebody who's in Chicago, who doesn't know the lay of the land here in Grove City, for example. So I'd say that's the main advantage of working with a community bank. And another example is if you look towards the whole COVID-19 pandemic that we had, or that we're in, and we had the SBA PPP loan for payroll. The community banks, if you really look at it, did the majority of the loans. They may not have been the biggest loans, but we did the majority of the loans as far as number-wise. And it really helps if you just had that community banker, you have that relationship with them, they could call you up, they could ask questions, and they didn't have to get a voicemail, they actually got a hold of me.
So as a community bank, are you restricted from doing loans outside of a particular geographic area, like outside of a certain county or outside the state of Ohio? Or are the restrictions really more just because of more of a practical nature, like because they're just outside of like your service area?
Sure. As a community bank, we like to stay within our community, of course. With that being said, I can't speak for every bank, but our bank, we like to lend where we have a branch in the surrounding counties. So for Vinton County National Bank, we have a presence here in Central Ohio, so it'd be all of the Central Ohio counties. And if you kind of picture the 33 corridor and the 23 corridor all the way down to the river, that's kind of like our footprint. So basically, we like to stay within the surrounding counties of where we're located, not really go beyond that. The other practicality of it is you don't really know other areas. I really know nothing about the Toledo market, so why would I want to go up to the Toledo area? I do know about Central Ohio, so that's kind of like where we want to stay. Know your market.
How many years in business do you usually look for when a company is applying for a loan? How many years in business do you usually look for, and why that length of term in business?
Well, typically we like to see at least 2 years in business. However, there are exceptions to all that. I think the Bureau of Labor Statistics shows that 21% of all businesses fail in the first year, 30% of the businesses fail in the second year. So we really like to see 2 years of tax returns under their belt to see what kind of cash flow that they're generating. Now, I said there are exceptions made. For example, right now I'm doing a loan for a gentleman who is buying a franchise for a robotic company. He takes it into schools and they'll build the robot and they'll program it, and kids can be playing with this robot within an hour after he arrives. Now, the reason why I'm saying there's exceptions to that, he's also a 28-year computer teacher for New Albany. So he's got that experience behind him. He's been doing this part-time for the last 3 years for a different company, and so he's finally ready to buy his own franchise. So right now I'm going to be looking at doing a loan for him, and he hasn't even started his business yet to buy that franchise. So typically it's 2 years, but there's always exceptions to that rule.
Roger, I think one of the questions that entrepreneurs often have, they have an idea that they're going to go to the bank and get a loan, and they view it, perhaps at first, if they've never done that before, they view it as really a very general loan, like they're just going to get $50,000 to start their business, and they don't often realize that understanding exactly what they're going to use those loan funds for is going to really impact their ability to get a loan and even who they would go and get that loan from. So can you help us understand why what you're going to use the loan for makes such a big difference in getting a loan?
Sure, there's several different types of loans out there. There's, of course, there's loans to buy commercial real estate for your office space. There's loans out there for capital, for working capital, which might be a revolving line of credit. And that's what it really boils down to, is what is security on the loan. So if it's commercial real estate, it's something you can physically touch. You know, you can go see the building, you know exactly what you're lending on. Whereas if you're lending on for operating lines of credit, you really don't get to see all that. You might see accounts receivable would be the security, or maybe other business assets might be the security, but you really never get to see that. So typically on commercial real estate loans, you can have a longer amortization on your loan, whereas on working capital, if it's a line of credit, we typically renew those on an annual basis, just so we can see how you're handling it. So we like to see a pay down. For example, we like to see a pay down to zero if it's for operating capital, at least for 30 days, sometime during the last 12 months.
So as like a follow-up to that question, if I was an entrepreneur that was trying to get a loan to buy a piece of commercial property, that's one scenario. Another scenario we often find is they need money for leasehold improvements. And how does the bank look at that type of loan differently, where they're going to be spending all that money on these leasehold improvements that maybe would not really belong per se to the business itself? They might be something that's going to be altering the property to benefit the business, but aren't necessarily an asset of the business.
Right. Well, again, we kind of look at the business assets. So we may not take the leasehold improvements as security, but perhaps the business has other assets that we could use as security. Again, accounts receivable, inventory, cash in the bank, things along that line.
So when it comes to banks making a loan, I know that some banks will keep those loans and service them for the life of the loan, while others will sell those loans. And wanted to know, like a community bank like yours, which of those do you typically do?
Well, typically on our conventional loans, we retain those and service those ourselves. So you'd be making your payments directly to our bank, whether it be commercial real estate or an operating line of credit, like I spoke about earlier. Now, as far as SBA loans go, there's two different main types of SBA loans. There's one that's called the SBA 504, and that's usually on real estate. It's a 50, 40, 10. Think of it that way. You put down 10%. We make two loans, one for 50%, one for 40%. Once you move into that property, the SBA will come in and take out that 40% from us. And then we retain that 50% loan on our books. But yeah, you will be making payments to the SBA on that 40%. The second type of SBA loan that's out there is called the 7A. And that's where the bank receives a guarantee for that loan. That guarantee could be anywhere from 50% almost to 80%, sometimes 100% on certain loans. Some banks will sell off that loan, that guarantee loan, as a premium. We do not as a bank. We retain all that. But that is always an option. There are some farm loans or ag loans that we can sell off there on Farmer Mac, but we typically retain those as well.
So we know every time we go to apply for a loan with a bank, we're going to have to provide our business tax returns and our personal tax returns for several years. And can you help me understand, are there specific things that you're looking at in those tax returns? Like how deep do you dig into those tax returns, or are there just really a few key pieces of information that you're gleaning from those?
That's a good question. Typically what we look for in personal and business tax returns is cash flow. And then we drill that down to global debt service coverage. So in a nutshell, we look at, can you pay your bills and can you afford this payment overall? And that's really, it's not rocket science. I mean, that's what we're looking for, is cash flow, and then a global debt service coverage ratio. We typically like to see a 1.25 debt service coverage ratio or larger. And what that means is we take your total income, total cash flow, divide by your current debt, and we like to see that's like, basically it's saying you can pay for your debt once over plus a 0.25% overage on that. And then we also look at a personal financial statement in addition to tax returns. A personal financial statement, in a nutshell, it drills down to your net worth. You list all your assets, you list all your liabilities. We look at both and we come to, like, if you liquidated everything today, how much would you have left over? And we like to see a positive net worth.
So thanks for explaining to us all of the different things that you're looking at on our financials. How does that process differ if it's an SBA loan versus a conventional bank loan?
With an SBA loan, there's a lot more documentation needed versus a conventional loan. they're going to want to see not only tax returns, but 3 years of profit and loss or income statements and balance sheets. I typically, if I have the tax returns, I don't need that. So right now, we're at the time of year where a lot of people might be on extensions for 2019 tax returns. So that what I would ask for is then the 2019 income statement and balance sheet, along with the year-to-date 2020 income statement and balance sheet. But SBA loans, I'm not going to say they're easier to get. Sometimes if we're doing a 7A loan, like I said, you have that guarantee. Sometimes it helps the bank feel more comfortable with making that loan if they know they have a 50% or 75% guarantee. Or on the 504 loan, you only have to put down 10%. Now that sounds like that's a great thing, but just keep in mind, 504 loans, you're probably looking at 3 to 5% in fees for that loan. The good thing is they'll let you finance it inside the loan, but you're still paying a lot more in fees for the SBA.
So Roger, what do you feel are some of the things that are unexpected for a business that's applying for a business loan for the first time? What are like kind of the parts of that process that are unexpected? Is it have more to do with the kinds of financial information they're going to have to provide? Is it how long the process takes? Are there unexpected costs in doing that they are unaware of? Is it, how much money they have to have down for the loan? Like, what are some of those things that are most common, like maybe misconceptions or just things that are unexpected to the small business owner?
Sure. Probably have to do with the personal financial statement. As a small business owner, go onto YouTube, Google it, but learn how to fill out a personal financial statement. There's a lot of small business owners out there that you give them the form and they have no idea what it looks like. And I always try to help them as the best that I can, but I can't really tell them what to put in there. They have to kind of do it themselves. There's different forms out there for a personal financial statement. So I would say just Google one, look at it, fill it in, and that way, do it annually. That way you'll have it for your bank. If the banker asks you for it, you can just produce it right away. Typically, when we ask for financials, we like to see a personal financial statement that's no older than maybe 60 days old. The other thing that you want to prepare yourself for, depending on your loan size, for my bank, it's $200,000 and over, is you need to give annual financials to that company, that bank. So be prepared April 15th, or in this case, July 15th, or October 15th, if you're an extension filer, your banker's probably going to be calling you, depending on your loan size, for your annual tax returns. So don't think anything of it. It's not that they're going to call your loan. It's just what happened during the recession in 2008, 2009, with all the new bank regulations, the federal government is forcing us to do an annual review of certain loan sizes. And like I said, it's different for every bank. My bank is $200,000 or more, or a line of credit that is over $100,000. So be prepared for that as well.
One of the concerns that a small business owner might have, which you touched on in your previous question, was what kinds of things can happen where a bank calls my loan, or where my loan would be foreclosed on. Like, what are the kinds of things that have to happen that would create such a situation?
Well, the last thing that we would want to do is foreclose on a piece of property or call a note. As long as your payment history is good, and you can provide your annual financials, and it doesn't look like your business is going downhill, we're not going to necessarily call your note. As far as a foreclosure goes on commercial real estate, as long as you're making your monthly payments, we don't have an issue with that. Where we sometimes run into something is you have an operating line of credit, and like I've said in the past, we'd like to see you zero that out at some time during the year. But if you don't, and you max it out, and it just stays there. Typically what we will do at the end of that, when it comes up for renewal, is we'll term it out. So instead of giving you a line of credit, we'll just term it out for the next 4 or 5 years, so that's eventually it'll get paid off.
One of the questions that people are often thinking about is, how long is this process going to take? And can you maybe shed some light on that? And also, like, how that might be different for a line of credit versus purchasing a commercial property versus getting an SBA loan. Would those things take different amounts of time? And what is a good time frame for people to expect?
Yeah, good question. On a real estate loan, you're probably looking at least 30 to 45 days right now. And I can speak of, at my bank, we can have the approval for you. Once we receive all the financial information, we can have the approval for you in probably 5 to 7 business days. What's taken the most amount of time right now are appraisals. Your appraisal can run out for 2 to 3 weeks before we get it back and get a chance to review it. So if you're looking at purchasing commercial or investment real estate, plan on a good 30 to 45 days. Now, an operating line of credit, like I said, our underwriting time is about 5 to 7 business days. As long as we have all your updated financial information or current financial information, we can typically get those approved and closed within 5 to 7 business days. Now, the SBA, on the SBA 504 program, that can take maybe an extra 2 to 3 weeks. And on the 7A, there's different types of 7A loans. As a bank, if you're an express lender with a 50% guarantee, you can use your own documents. If you want to go call it fully underwritten SBA 7A loan, that can take upwards to about 30 to 45 days to have them underwrite that for you. So it just kind of depends on what you're looking for, what you're looking to do.
And all of those timelines are really starting from the point where you have the full loan package, is what you're saying. So that's
correct.
Like that clock doesn't really start ticking until you have all of the materials together, all the tax returns, financial statements, personal financial statement, all of the other things that might be relevant to the loan itself.
Correct.
So that's when that time frame would start.
That time frame will start once we have all your current financial information.
So as a business is getting started and they're getting some traction and they are growing and they need to have additional equipment and property, and how common is it for them to have multiple different kinds of loans with the bank, and what are some things that they might need to think about in doing that?
Sure. I mean, you could have multiple loans with one bank, especially if you're buying equipment. If you're using vehicles for the business purpose, you may have 4 or 5 different vehicle loans. You may have 4 or 5 different equipment pieces. It just depends on what you do, what you're looking for. As far as real estate, typically you only have one loan on your property, unless it's something like an SBA 504, where again you have a 50% loan and a 40% loan. That 40% loan will take second lien position. And there's always instances where a client may come to you and say, hey, I need a piece of equipment, but it's not worth as much as I'm going to be paying for it. Well, then we could always maybe use the real estate as well as additional security or as an abundance of caution.
So we definitely believe in the importance of having a relationship, with your bank. Why is it that banks really seem to insist on having your business accounts when they do a loan for you?
Well, number one, we like to have that relationship with you. We like to see you come into the branch, make a deposit every once in a while, say hi, have a cup of coffee. The second reason is you're using our balance sheet for that loan. So you're using our assets for that loan. So we like to see you make a commitment to put more money back into our bank. Now, believe it or not, a deposit account is actually a liability for a bank. It's not our money. So we actually have to treat it as a liability. But the nice thing, especially about a community bank, is we use that money locally. So someone who opens up a CD or opens up a checking account here in Grove City or Pataskala or Canal Winchester, typically we're going to lend that money out to people, businesses in that surrounding area. So that's why we like to maintain that relationship. Number one, that deposit account is number one for the relationship, but also to keep the money coming in that we are also lending out.
So can you help us understand the importance of a personal credit score for an individual, a business owner? Like how does their personal credit score weigh into them getting a business loan? And what are sort of the range of scores that most banks would typically be looking for?
Sure, another good question. Your credit score can be anywhere from 350 all the way up to 850. As a bank, we like to see a credit score of at least 680 or higher. What the credit score does, it's kind of like a risk rating on you. The higher your score, the less risky you are to do a transaction with, to do a loan with, your landlord, your insurance company, everyone else that looks at that. As far as what we use a credit score for on a business loan is, we structure a business loan as the loan will be in the business's name, but we're going to have you as a personal guarantee on that. So your business loan will not show up on your personal credit report, but we will ask you to guarantee it. So once again, it's kind of like a risk rating of how you pay your bills, your credit score is. And yes, it is very important. We do look at it. Like I said, as a bank, we don't like to see credit scores below 680.
So when it comes to getting a business loan, especially as a new business, I'm going to be making a personal guarantee that our business will repay that loan. Well, help me understand what that actually means. Like, what of my personal assets are now at risk because if I don't pay that loan?
Sure. Again, the loan will be in the business name. And however, if at any time the business cannot make that payment on time, we will ask you to personally come in and make that payment. So it just depends on your institution. If you're an LLC, you may have 4 or 5 members, each 25% member of the LLC, we're going to have each one of those as a personal guarantor on that loan. So if the business can't make it, our next phone call will be to the personal guarantor saying, please come in and make that monthly payment.
Can you help us better understand what a working line of credit is and how much of a working line of credit a company typically would have and the kinds of things that they would use that for?
Sure. A business line of credit or a working capital loan, it's like a revolving line of credit. We would look at your balance sheet, look at your assets. What do you have in assets? And then what do you have in accounts receivable? Typically we'll go maybe up to 50% to 80% of accounts receivable that are less than 90 days. So when we're looking at that, we're going to ask you for it's called an aging accounts receivable list. And then we look at that and we'll gauge on how big of a credit line we can give you. Also, when it comes to just the business assets, typically when we do a line of credit like that, as collateral, we'll do all current and future business assets along with accounts receivable. And that includes inventory, depending on what you do, but it also includes inventory. So it just depends on what the assets are of the business, and typically you're looking at 50 to maybe 75% of whatever that total is, as far as the size of the line of credit.
So a business that has large amounts of accounts receivable would be able to get a larger line of credit or additional business assets. But it sounds like if I'm operating a cash-based business, like maybe I have a restaurant or a food truck or something where people are just paying me for the services as they're rendered, I don't really have much in the way of inventory, then would the working line of credit really just be largely then based on the business assets that we have?
Yeah, so it would be based on the business assets that you have. And a lot of people use your business line of credit or working capital for a lot of different things, but most businesses will use it for their accounts payable or accounts receivable. So you may have stuff that's out there that's 35, 60 days out, but you still need to pay that employee this week. So they may need to tap that line of credit in order to make payroll, but then in 30 days, they can pay that off once they get paid. So as far as it kind of varies from industry to industry. If you're a restaurant, you're going to have equipment that's hopefully free and clear. Maybe you have real estate. If we have the first mortgage on a real estate, we might be willing to also secure a second lien on that to give you that operating line of credit. So it's kind of on a case-by-case basis.
Do you have any last words for us in terms of what we should be thinking about as a small business owner that's thinking about getting a bank loan?
Start off small. Don't think that, and also make sure that it's relative. If you're a CPA with a background, 20 years as a CPA, don't think that you're going to go out and be able to get a loan by starting up a coffee house right away. It's not in your wheelhouse. However, again, if you're a CPA with 20 years experience, you want to open up a restaurant, tell us your story. We're going to look at that and say, this guy has no experience opening up a restaurant, but maybe you worked for your mom and dad all through high school and college at their restaurant, and you worked there off and on postgraduate, and so you know the restaurant business by the back of your hand. So give us your bio and tell us why you're wanting to do what you want to do. Also keep good financial records. Like I said, there's nothing more important than looking at current and past financial records. We want to see that cash flow. We want to see that debt service coverage ratio.